I'm going to talk about some work we do on strategic analysis of algorithmic trading scenarios. Stefan said I'm from the University of Michigan. I lead a group called the Strategic Reasoning Group. And what we do is we try to understand very complex multi-agent scenarios where there's strategic behavior. And certainly the world of trading and financial markets fits the category of motivating domains. We have a broader agenda to try to understand what difference does AI potentially make to financial markets and the financial system. There is reason to think that as trading gets more and more automated, as it already has, things may be qualitatively different. We want to understand that. It's not the case that either it's good or bad. There's going to be some techniques in algorithmic trading that are going to make markets more effective, more efficient, but there may be others that may be deleterious, and we want to be able to parse that between. We want to understand how to design markets so that they're safe for the AIs, or that they promote the more beneficial behaviors and they try to deter the negative behaviors. The approach that we take in my group to analyzing these strategic scenarios in finance as well as in other domains is as Stefan said, a combination of agent-based modeling and game theory. So the advantage of agent-based modeling, or simulation approaches in general, is that you can handle complexity. Whereas there's going to be limits to what you can do analytically as you add more complicated features into a scenario, more agents, more uncertainty, more dynamics. But simulating them doesn't cost any more. However, the problem is if you can get any kind of results out of simulation, maybe you want, if you can choose, if there's so many degrees of freedom in the environment and in the behaviors. So you need some discipline, and that's where we bring in the game theory to say we're going to insist that the agents obey at least some strictures of rationality, that we use the rationality as a filter to say these are the ones that are actually plausible outcomes. So in order to faithfully model financial markets, we need scale, heterogeneity. We need to be able to handle microstructure, the interactions at the fine-grained level, the information flows, but we still want to be able to do game theory on it. We've applied this approach in many different questions in financial markets, latency arbitrage, and so on that I listed here. In this talk, I want to give you a flavor by going into two of them. And even given the time, I have to gloss over many details of the scenarios, but I hope I can bring out the logic of the reasoning that goes into it. So the two I'm going to cover pretty quickly are market manipulation in the form of spoofing and a study on trend following trading strategies and their effect on market stability. Okay, so let me first go into market manipulation. Actually, I had a paper with a colleague in the finance department at my university named Uday Rajan on trying to develop a framework for thinking very generally about what it means for trading agents to be well behaved. And we came up with a four-tiered structure, sitting back and saying, well, automating trading strategies can often be thought of as implementing some form of arbitrage. Agents that are just good at looking at market situations and seeing where there are either deterministic or statistical arbitrage opportunities. So the most benign form of that is when they're just looking at the markets and they're passively searching for arbitrage opportunities and jumping on them. Now, if agents are very good at that, and maybe because they're fast and they can look at a lot of things at the same time, things that you really need computers for, then they're very tempted to say, well, if I could make it more likely for these arbitrage opportunities to happen, I'm going to be more profitable. So level two is amplifying arbitrage opportunities by moving the markets. If I can make the markets move, then there's more likely an arbitrage opportunity will show up that I can exploit. And in fact, you could even push the envelope further and say, if I can shape the market structure to make these arbitrage opportunities more prevalent, say by fragmenting markets, that might be a thing that would happen. Developing new financial instruments that not everyone understands so well, but will make more arbitrage opportunities. And going all the way down to level 4, which is techniques to actually subvert markets. What I want to talk about today in the market manipulation section is level 2, amplifying opportunities through market manipulation. This is something that in the US regulation defines. SEC has a definition, intentional conduct designed to deceive investors by controlling or artificially affecting the market for a security. The Dodd-Frank legislation that adopted in the US in the wake of the financial crisis also has a definition for spoofing, basically putting in orders that you intend to cancel before they're executed. If you intend to cancel before they're executed, why did you put them there? Well, the implication is you put them there in order to mislead others. That's their point. This is something that happens all the time, and I'm going to talk about our recent work here. So showing a bunch of news articles that point out, yes, people do this, and sometimes they're caught, and sometimes they're investigated. For our purposes, I'm going to use the label spoofing for this practice of putting in large spurious orders, these ones that you don't really intend to execute, in order to affect the beliefs of others. Okay, how does that work? Well, this diagram comes from actually a report on a proceedings of a report on a court proceedings for somebody who was caught doing spoofing and prosecuted. And let me try to just quickly explain what's going on. So at the left, they put in a true buy order. When I say true, that means that's the one they really did intend to execute. But then they wanted, of course, the price was above that. So what they did is put some spoof sell orders, those are the red ones on the left, to try to tell the market, hey, there's some big sell pressure coming. And in fact, they show it going down in time. This is a technique called dynamic layering. And if people believe those are real orders, they might say, oh yes, the price is likely to go down soon. And in fact, this trader was ultimately able to sell right here at the price offered. So they bought the security. Then they say, okay, I bought it, now I want to sell it. So they put in a sell order at a higher price. This is the arbitrage, if I could buy and sell at the prices I want. Now they're going to sell it, and in order to get the price to go back up there, they put in some spoof buy orders to tell the market, yes, there's going to be lots of these. Now they put these orders in out of the money, okay, and they try to do it in a way that they can quickly yank them back if there's a chance that they're going to be executed. Maybe there's some risk involved, but this is kind of the textbook spoofing. Okay, so our study asked the question, can we model this? Can we recreate this kind of spoofing in the laboratory? And moreover, in a way that even rational traders can be spoofed. Okay, so rational in some sense. And then we want to say, okay, if we can recreate this, what can we say about what impact does it have on the markets? Does it have efficiency costs? Who gains? Who loses? Can we quantify the effect? And this project was led by my student, Xintong Wang. So first, as I mentioned, we combine agent-based modeling and game theory. And here's a little cartoon about how we do it. So we lost the animations here. I think this might be the PDF. What we do is, this is kind of a stylized game matrix. And on the columns and the rows here, you can think of as trading strategies. Okay, they're written as like their little code. Now, of course, there's way too many possible trading strategies that you could ever build this whole matrix. But we may be able to smartly enumerate some key trading ideas and as heuristic strategies, and cover what we think are the kind of important strategies that might be considered. And then we can't actually figure out what goes in the matrix short of actually running these strategies against each other. And of course, it's not just two traders, but I can't draw more than a 100-dimensional matrix for you if there's 100 traders. But we can simulate 100 traders. And what we do is we run these trading strategies through our computational cluster, and then we use the data there to fill in the matrix. Okay, and so over time that'll get all, and we don't have to fill in the whole thing. We can often determine that there are equilibria just by looking at parts of that game. Okay, so I'm not going to go into too much of the mechanics of empirical game theoretic analysis, the methodology we've developed to do this, but I wanted to give you the idea that we're going to use simulation data to build a game model that we can then reason about. And all the results I'm going to show you are comparisons of equilibrium behavior among this population of heuristic trading strategies. Okay? So the first question we're going to ask about the spoofing is, this scenario is, are agents going to be susceptible to spoofing? And we have two categories of trading strategies that we considered in this model, and the details of them are not important. HBL and ZI, HBL stands for heuristic belief learning, ZI stands for zero intelligence. What's significant for our current purposes is that the heuristic belief learning agents derive beliefs about the likelihood that certain orders are going to transact or not based on looking at the order book and looking at transaction history. The zero intelligence agents, as the name might suggest, are kind of oblivious, and they just decide what they want to order based on their own understanding of the fundamental value and their private values for trading. And we have different versions of these with many different parameterizations, but the question we want to ask is, in the presence or absence of spoofing, which kinds of agents will you see in the market? So when there's no spoofing, what these graphs show is the HBL adoption rate for 9 different particular scenarios. And they're just labeled here A1, A2, and so on. Just think of them as different market shapes and sizes and parameters, different scenarios. And we find that in most of these, we get a very significant fraction of HBLs, which means it actually is valuable to look at the market, to look at the order book in order to make your trading decisions in our model. Okay? Why does this matter? Well, one way to avoid being spoofed is to not look at the market order book. If you don't look at that information, you're not going to be misled by it. So you need that traders are actually looking at it in order to have a market that's susceptible to manipulation. Okay. Is it good that agents are looking at the order book? In fact, yes. So we looked at market situations where you have HBLs and ZIs or only ZIs. That is, no one's allowed to look at the order book. And in fact, you get better price discovery. In this case, price discovery is the accuracy of the markets being able to track the fundamental value of the securities. You get that better when agents are looking at the order book. Okay, and under our model situation, maybe not too surprising, but the blue circles are generally lower than the triangles. Lower means more accurate price discovery. We also improve efficiency, measured in terms of gains from trade or market surplus. So when HBL is allowed, you get more surplus. And then finally, spoofing actually works. So we can plot here the difference in the price trajectory you get if you put in a spoofer or if you don't under these different scenarios where there's a smaller market or a larger market. And of course, the exact trajectories vary, but at the point that spoofing starts, you get a large and fairly persistent boost in the price when you're boosting it, when you're spoofing in the positive order. And you get more, depending on the markets with more HBLs in them, have a bigger spoofing effect than the ones with the oblivious agents. Okay. So how does it matter? Well, what this shows is the difference in surplus achieved by the background traders in the presence or absence of spoofing. So we took the difference, and what we find is if you look at the blue, the HBL agents suffer a lot. Their profits go way down when there's a spoofer around. They're being misled. The ZIs are not misled because they're not even paying attention to there. In fact, they actually do better when there's a spoofer. Somehow now the amount that they do better does not nearly make up for the loss to the HBLs, but we thought it was actually kind of interesting that the oblivious ones were actually better off by the fact that someone was manipulating the market, because they just gave them sort of more regular, it was more noise out there that they were getting, could get benefit from. So now the strategic question, if there's a spoofer, would you still pay attention to the market? So I showed you first there was a tendency to look at the market information. It turns out even with a spoofer, so now the triangles are in the market with spoofing or without, the prevalence of HBLs tends to go down, but it doesn't go to zero. Okay, at least usually doesn't go to zero. So what we find is that in the presence of a spoofer, there's still some benefit at the margin to paying attention to market information for at least some fraction of the agents. Okay, I want to go on to the next topic. So just summarize quickly. We were able to create spoofing in the laboratory. Lot of follow-up questions. Are there ways to design markets that are more resistant to spoofing? Yes, we had some ideas about cloaking mechanisms that hid particular parts of the market. Traders themselves can make themselves a little bit more resistant by ignoring certain information. Ultimately, what we'd like to be able to do is build a market manipulation detector using this kind of model, and that's the kind of thing we're working on. It's actually quite difficult to do. Okay, let me move on to the next topic, which is financial market stability. We want to understand, could algorithmic trading affect whether markets are more stable? And the version of stability we're looking at here is, assume there's some kind of shock to the market. Is that shock going to be attenuated or amplified? If it can be amplified, then you have some potential. So are there some things about algorithmic trading strategies that could affect stability? And this was led by my former student, Eric Brinkman. In this case, the canonical algorithmic trading was a very simple technical trading strategy, form of trend following. Not suggesting anybody literally does this, but a lot of trading strategies can be thought of doing some very short-term extrapolations of things, and what effect does that have? What we show is that given the market frictions in our model, these actually can be profitable, these simple technical strategies, and we can show their effect on stability and performance. Okay, so these are the kinds of pictures I'm going to show you. So the yellow here is a trajectory of the market fundamental. Okay, so we have a model where there's some stochastic process that generates a true value of the security called the fundamental. The gray here is the price trajectory, which and the gray is without a shock, and it pretty much tracks the fundamental. It doesn't perfectly. In this world, the traders arrive, they observe the fundamental, and then they trade based on the fundamental and their own private values. It doesn't totally track the fundamental, partly because of the private values, but also partly because they're trading possibly with somewhat stale orders. Agents arrive not continuously, but only periodically or according to actually a Poisson process. And so they'll put in a limit order, which may trade right away, or it may rest in the order book, in which case it's going to get a little bit stale, and it's going to reflect some old information. Okay, we put in a shock at this point, and what we see is the shock, that is, we put in a big order on the sell side. It makes the price go down immediately, but it recovers pretty quickly, at least in this version of the model. Okay, this is a version of the model with only ZI agents that don't look at the prices, and so since they're seeing the fundamental each time, the prices are going to come back. Okay, but if we add now that the agents don't observe the fundamental exactly, but rather only with some noise, which is more realistic, then that means that there's information in the market that they could exploit, right? So if I observe a noisy fundamental, I could look at the market prices and say, well, maybe my estimate was a little bit off, and others got other observations. They know things that I don't know. I should adjust my offer based on what I see in the market. So actually, if I'm paying attention to market prices, which under normal situations is good, and then we put in a shock, well, now the shock is going to have more of an effect, because when the prices go down, I'm not really sure, is this just some kind of big order that came in, that is at random, or hey, does somebody know something about the fundamental that I don't? And it's going to take a while for that to get sorted out, and so the effect is going to persist longer. Okay? If nothing changes. Agents believe the prices they see, so when they see something change, they say maybe this is real, it's going to have an effect. Well, in a world like that, what you get is that if you look at trends, they have information in them because of the persistence. If the market is wrong for a while, it's going to stay wrong for a little while longer and only slowly adjust. If you look at, so a trend here is defined as price movements that are in the same direction. And the fact, if you see a bunch of price movements in the same direction over a period of time, it suggests that, hey, there really has been a move in the market. It's taking a while to adjust to it because of stale orders. That trend is likely to continue for a little while longer. And if we can measure the amount of mispricing, it's very correlated with the length of a trend. Okay, so if I see that, I say I can give you a profit-making strategy, follow trends. Right? Because they're likely to persist for at least a little bit. Okay, so sure enough, we introduced this trend following strategy, and it's very simple. It just looks for trends. It has some threshold, based on if the trend is 4 or more, I'm gonna try to jump ahead of the trend. In fact, this trend following strategy is profitable, and it's present in equilibrium in this model with noisy observations. What happens if we have a model, now we have these trend followers, we have the regular agents, we introduce a shock now? Well, now the trend followers exacerbate things, right? Because they're following trends, and when there's a big shock, they're going to push that shock to go even further. They're going to amplify it because they're following trends. And it's going to take longer to come back. So that's a case where you could say that the trend following is exacerbating instability here. But wait a second, the trend followers also have an effect on the whole market response to everything, and they get rid of some of this because they're exploiting the mispricing. They're going to reduce the mispricing, right? They're actually adding some efficiency there. If you add the trend followers, you have less of this effect of how trends are indicative of mispricing. But that also means that when there's more trend followers, the price information that you see is less accurate as a reflection of fundamentals, right? So if some traders are trading based on fundamentals, some are based on trends, now when I see the prices, some of it was formed by the trend followers, I don't want to pay as much attention to the prices anymore. So in fact, when you add the trend followers and re-equilibrate the market, the game-theoretic equilibrium, the fraction that use the price information goes way down. Because of that, now when we look at the shock response, so this is the gray was what we saw before when we had noisy information, a shock happened. Now we have trend followers. That means also fewer using price information. What we see is that the shock goes a little bit further down. So it does exacerbate it, but it also recovers much faster. Okay, so think about what's happening there. Fewer agents are paying attention to the prices, so they're not going to prolong the price effect. The trend followers, they pushed it further down, but they're also going to help on the way up to get you back to normal faster. So it was a kind of a mixed strategy. What we find with the trend followers is that they exacerbate the shock impact. They make it go deeper. This is the max difference. With the trend followers, it's a little bit higher. But here, root mean squared deviation, that's kind of a measure of the area of the shock effect, the area under the curve. That's a little bit less because they recover. You go deeper, but you recover faster. That's what we find. Overall, there was a reduction of market efficiency with these trend followers. Okay, they made it more efficient. They made this trend anomaly go away, but by crowding out the ones who are using price information, they're making the market less able to aggregate information across from different noisy observations. Okay, so this was meant to illustrate, and I hope some of the logic came through, how we think about these kind of algorithmic trading strategies in a particular model. It can be rational to use these simple technical strategies when there's sufficient market frictions. In this case, the frictions are imperfect fundamental information and some delays in how quickly agents can get to market. And it affected market performance in somewhat sensible but a priori surprising ways. Okay. So I'm out of time, so let me just leave you with a closing thought that understanding the effect of algorithmic trading, I think, is a great area for AI researchers like myself, because it really is the leading edge of where autonomous agents are being deployed in the world. We can ask important questions about how does that change that world, and it's a very high consequence world. This technique of combining agent-based simulation modeling and game theory, I think, hits a sweet spot of being able to handle complexity, but still some discipline in looking at effects when agents have some rationality standard. And so we're exploiting in a lot of other domains as well. Thank you.